Well, good afternoon, everybody, and welcome to our next charitable giving webinar. I'm Michael Horn, and with me is
Daniel Mills.
And Scott Vigneri.
and Scott. If you want to take us from here.
All right. Well, we've had, I think would be our fifth or sixth webinar, and we've been talking about charitable giving and ways to do that. Last month, we talked about life insurance, and we're actually going to spend quite a while on life insurance because there is quite a bit there, to be honest with you. And we're going to talk about last month, we talked about term insurance and the final expense. Today, we're going to go into a little more depth about permanent life insurance and some of the differences. So with that being the case, Michael, if you want to start the slides.
There we go.
And I like starting out with this slide because I don't know about for anybody else, but this is a good, not necessarily a reset, but it helps me anchor on why we're doing this. And if you're here today and you just happen to be here, and we are going to be talking about the Bible and Jesus and missions, you're welcome to stay. But if that doesn't fit you, then you're welcome to leave, but you're also welcome to stay. And we'd love to have you stay. But this little girl is down in the Honduras and up in the mountains. And obviously, they don't have a lot there, but yet they need the gospel. And as I say every time, this little girl, God knows her fears. God knows her heartaches. God knows her concerns. God created her. And God created everybody. You're going to see other slides of other people on here. And God created all those. And that's what this is all about, is finding ways to fund and get resources to get the gospel out. Because there are many, many people that want to hear the gospel. Some people don't want to hear the gospel. We're not here for that. We're here for those who want to hear the gospel and have never had the opportunity. And life insurance can be a very big part of that. So if we want to go to the next slide, please. There we go. And as I mentioned, my screen is showing all of us over here where I can't see these people. So I'm going to minimize you, Michael and Daniel. Nothing personal.
Go for it.
So we have a couple of children here, and we have a couple of older people here. And again, what we're here today to do is to learn to use the power of life insurance to help get the gospel to the world. From the Philippines to Africa, there's parts of Africa where they are murdering Christians. But I know several missionaries. I know one in Tanzania, and I know one in Kenya. And I know a group in Ghana. And then we go over to South America. There's people in Peru. I have a good friend. He's been in Brazil now for many years. And I know some other people over there as well. And then we go to Honduras, which is close to Brother Nelm's heart. And then Guatemala, Panama. And then we move on up to Mexico. And I know a few gentlemen up there in Mexico City that they have a phenomenal work. So around the world, and I think I mentioned the Philippines. And then we talk about Ukraine, going back around to the other side. Many, many people over there faithfully serving God. But they all need the resources. And again, we have pastors in Pakistan and Iran and Iraq, and they need the resources. Permanent life insurance can be a very powerful tool to help with that. So let's move on to the next slide. So let's kind of rehash term versus permanent. Term is exactly that. It's a fixed term, a fixed number of years, but there is no cash buildup. It is usually less expensive, but when it's over, it's over. You know, you've paid all those premiums, and let's say you get a 20-year policy, you start at age 30, it's very inexpensive at that point. $20 a month, depending on how much you get, you know, what your face amount is. Even $1 million policy wouldn't be very expensive on a term basis. But 50 years old, it's done. And the money you've spent, it's gone. But you need to decide, I had that protection, now it's going to run out. There's also what they call convertible term, that you can convert it to a permanent policy at some point in the future. That does have to be done before that policy expires or ends, before that term ends. And the rates will be made according to your age at the time that you convert it. So let's say you bought a $1 million term policy and you're paying $50 a month. But if you convert it, you probably won't get the full million. And then you will pay a little more. Let's say you convert it to a $250,000 policy. And then your premium goes up to $150 a month, something like that. So yes, the cost would go up. Permanent is more expensive. We'll get to that. So term, there's a place for term, and it's very suitable in many cases. Many times, a lot of people will use a blend between a term policy and a permanent policy. They'll have the permanent policy as a basic policy, and they'll have some term within there for a term of time. So you buy a permanent policy, you need, you know, the children are growing up and you need coverage for them in case something happens, they can cover college and so on and so forth. But now they're grown. You don't need that anymore. That drops off. And you don't, you know, so the cost drops off. Your premium doesn't go down because that's all calculated in there. But it helps it to grow that much faster after that's come off of there. So term fits a purpose, has a need, has a place. Final expense, I don't have that up here, but final expense has a need, has a purpose, and it fits in the right place. I'm talking to a guy this afternoon. He called in and he wants a final expense policy. He just wants to make sure his kids aren't stuck paying for his final expenses. He hasn't done anything else. And a lot of times people put it off and then one day they realize they need to do something. And unfortunately, you know, it's more expensive, but at least they decided they wanted to do something for their family. So final expense has a place. And, you know, they're typical, on the average, $20,000 to $25,000 policies. And you could take a policy like that and designate a portion to go to some charity like Final Frontiers and help the gospel. And then the rest would go to your family to pay off, you know, final expenses. Now, permanent, on the other hand, is a lifetime benefit. They figure in most cases up to 120 years. If you live to age 121, you don't pay any more premiums. Your policy has become what they call endowed. The cash value has reached the point where it is equal or beyond the death benefit. And at that point, you can either take a check or you can just leave it in there and let it continue to grow. There is accumulation in there. It does grow. And there are tax advantages with permanent that you don't get with a term policy. Okay, let's go to the next slide. An elephant in the woods. I think elephants are incredibly fascinating creatures. They're not the prettiest, not the most beautiful, but incredibly fascinating. And National Geographic or Discover had a special on them, and they are just incredible creatures created by God. Now, there are many aspects of life insurance. There's term versus permanent. You'll hear the argument about that. There are tax benefits. There are tax benefits that come with permanent that do not come with term insurance. Use it as an investment. Do not use it as an investment. That is a huge argument. It depends on what you're after. Then you hear marketing and stuff like that, tax-free retirement. Use it for infinite banking and so on and so forth. So I'm sure many of you have heard the story about the blind men and the elephant. So this is kind of like that. The story goes that there were several blind men and they were invited or they came across an elephant. And one gentleman was at the front by the trunk and was inspecting the elephant's trunk. Another one was by his leg and he was inspecting the leg. And another one was by his side inspecting that. Another one was near the front inspecting his tusk. Another climbed on top somehow and was inspecting his ear. And another one wasn't quite as fortunate and was in the back inspecting the tail. And they all came to different conclusions. The one by the leg said, it's a tree. The other one said by his side, it's a wall. And the one on top who was looking at his ear said, it's a fan. The one looking at his tusk said, no, it's a spear. The one by his trunk said, no, it's a snake. And then the guy in the back with the tail said, no, it's a rope. Well, as stated here, all those things are like those things. His tail is like a rope. His leg is like a tree. His trunk is like a snake, and so on and so forth. But the actual thing is they are not those things. The whole thing altogether is an elephant. And comparing life insurance to an elephant is like, wait a minute, where are you going with this? But it actually is very pertinent. An elephant is incredibly powerful, and they are incredibly intelligent, and they're very, once you have made friends with them. I saw a video of a lady who was in Africa, and they would rescue baby elephants that became orphans because of poachers. And this lady had done this for 20 or 30 years with her husband, and her husband passed away. And this video shows her out in a field, we'll call it, and you see these elephants, and she gently calls them, and they are all running directly at her. And you're watching this, and it looks like they're going to just trample her and run her over. But as they get closer and closer, they slow down, and then they start gently reaching out their trunks and just, for all intents and purposes, hugging her, because she rescued them when they were children. She took care of them, and they didn't forget. Life insurance can be very powerful, and we need to keep that in mind. We need to look at the whole picture. Can you use life insurance for a tax-free retirement? Yes, you can, but that's not the only thing. Can you use life insurance for infinite banking? Yes, you can, but that's not the whole picture. Are there tax benefits to life insurance? Yes, there are. That's not the whole picture. Is it a good investment or not? Again, that's not the whole picture. And so I want to delve a little deeper and to look at the whole picture. So next slide, please. Life insurance is like a hammer. It shouldn't be the only tool in the box, but it should definitely be in the box. Abraham Maslow once said, to a man who is expert with a hammer, everything is a nail. I think I mentioned this either last month or the month before. No, Life insurance is not the answer to everything, nor is it always the best thing for everybody. And I know there are agents that are out there that will try to sell you a life policy to cure, you know, whatever, all the world hunger and so on and so forth. You need to find out what you want to accomplish and if it's right for you. But I do think that everybody should have some type of plan that would include life insurance, even a very basic term policy, so you can take care of your family and do it while it's affordable. You know, this kind of, that maybe seems contradictory. I say it should be definitely be in everybody's toolbox, but it's not for everybody. My dad was a mechanical design engineer, and he loved to tell this joke. And it's not really a joke, but he thought it was hilarious. And he would tell this joke about this company that bought this machine, and it took months for them to design it. And this is an interesting story because my dad designed a machine for a company in Germany, and they shipped it over, and on the way over, it sank. The boat sank. So they had to build it all over again. But so they built this machine for this company, and they got it up and running. It took almost a year. And boy, when it took off, it was running great. And their production just shot through the roof. And they were thrilled. And then one day, it stopped. And the maintenance men and their engineers were looking all over, and they could not figure out what was wrong with it. And finally, they called the manufacturer of the machine, and they sent somebody out. And the guy came in, just one guy came in. He had a little toolbox, and he opened it up, and he walked around the machine, and he put his hand over here, closed his eyes, and was listening. And then he went over to another spot, and he did this for, I don't know, half hour or so. And then he walked over to his toolbox, took out a little ball peen hammer, and went over to a certain spot, put his hand around and felt around and listened. And then he took that hammer and went pop, and the machine started up. And everybody looked at each other, and they went, "You got to be kidding." And they had no problems. So they got the bill for the repair, $10,000. And the owner said, I want an itemization. And they sent him an itemization. One ball peen hammer, $4.95. Knowing where to hit it, 9,900 and whatever it is. And that's the same thing with life insurance. It's important to use it in the right way. Don't buy a policy just to buy a policy. Make sure you understand what it's all about. Infinite banking is a very sound policy, but it's got to be set up correctly. Tax-free retirement is a very sound policy or concept, but it's got to be done correctly. So next page. So why do many wealthy people use life insurance? We think they all invest in the market and they own their own business. Very few people actually become wealthy by just straight investing. There are exceptions out there, but very few people actually become wealthy just through investment. Most people own a business or businesses, and that's where the bulk of their wealth comes from. And they use some of that to invest, and they do well with that. So it's not unusual to see a wealthy person have a $10 million policy or $20 million policy or even a $50 million policy and above. And there are cases where people like this have multiple policies. They'll have a $10 million policy and a $20 million policy and a $50 million policy. What do they know that we don't know? Is it some deep state secret? The actual truth is that everything that is available to the wealthy is available to you. It can be a very valuable tool for tax planning and for charitable planning as well. And whatever they do, obviously they have bigger numbers, but everything they do, you can do. All right, next page.
Wanting to be a little bit slow today, so bear with me. There we go.
Basically, it's okay. Here's one of those that changed. It's all about the tax code. And life insurance is built upon the tax code. But in some ways, the tax code was built around insurance. Why do I say that? I have one carrier, one company that refused to insure Napoleon Bonaparte, and they turned him down. And this was what, 300 years ago? So our tax code hasn't been out that long. But our tax code is built around, and life insurance is built around our tax code. It's not insurance companies trying to market some kind of product. And these are all built on tax code. Let's talk about dividends. Dividends are for you as a policyholder. You get to share in the profits of the company. And you can use those dividends to help build up the cash value in the policy. You can use them to buy additional insurance, additional protection. You can get a check. Once they send out dividends, you can get a check, and I'll send you that dividend check. Usually annually, is as often as it gets, but you can get those dividends because that's part of the profit. Cash value versus the death benefit. You can determine and decide and build and architect a policy if you want the cash value to grow the most, or do you want the value of the death benefit to grow? That's a major, major critical point. And what happens many times is people will do a concept like infinite banking, and it's not set up correctly, and it's built to grow the death benefit more, and they don't get the cash value they thought they were going to get. And so they get angry and they think it was a scam, but it wasn't put together correctly, and it was not a scam. It could be the agent either didn't realize it, or whoever put it together didn't know how to do it correctly. So I often say, make sure whoever you work with has the experience and knows how to do what you want to accomplish. If after seeing this, you say, you know what, I've heard about this infinite banking concept, I'm going to look into it. If you do, make sure the person you're going to talk to understands how to set it up correctly. It is, in this case, you want to make it more oriented towards building the cash value and not the death benefit. A lot of people aren't aware that you can do that. They just think you buy a policy and you get a death benefit. No, you can build it so that it focuses on one more than the other. Part of the problem, and agents are going to hate me, I'm going to get all kinds of hate mail on this one. But if I build you a policy and I build it to have a greater cash value, I reduce my commission. So a lot of agents are reluctant to do that. And hopefully they just refuse to do it instead of building a policy and say, yeah, we can do that. Again, make sure you know who you're talking to. Tax-free retirement, tax-free. You can see the policy grow tax-free and take out the funds on a tax-free basis. But there's a catch. You knew that, right? You knew there had to be a catch. There's always a gotcha somewhere. It's not a catch. We just got to understand how these things work. The IRS has a fence around life insurance. And as long as we do what the IRS says, there's no problems. And one of the things the IRS says is that if you pull money out of the policy, whatever you take out above that you put in, so let's say you've invested $100,000 and now it's worth 150,000, and you take out 140,000, you're going to pay tax on that $40,000 for whatever the appreciation was. But if you take it out on a loan basis, there is no tax. Wait a minute, that's my money. No, it's not. When you own a property, when you own your own home, and you've paid it down and now you have equity in that home, and you decide you need to buy a new car. So you go over to the bank and they give you a home equity line of credit for $30,000. Now, you've signed the paperwork, and the next day, these guys show up at your door in the backyard with a bulldozer and a bucket loader and huge gigantic saws, and they start cutting on your house. And they got a big fork truck. And you're like, what are you doing? Well, we loaned you $30,000. This is our $30,000 worth. Is that what happens? No. That is your collateral. And it's the same thing with the money that builds up in the cash value of a life policy. That is the collateral for the loan. It is your money. You are welcome to take it out, but there may be tax consequences. It also can reduce the value and reduce the buildup. It will reduce the death benefit of the policy. But if you just take it out on a loan basis, it doesn't impact the death benefit. Now, if you don't pay it back, yes, that will come out. So example, I have a $200,000 policy. I take out a $50,000 loan. I never pay it back. Then my beneficiaries will get 150,000 instead of 200,000. Some people, they plan it that way. They tell the family, we're going to use this and we're going to take out loans against this. But when the day comes, you will end up with this much. I will not take out any more loans than this. That's what a lot of those wealthy people that buy these 10 million, 20 million, $50 million policies. They use it to finance companies. They use it to, whatever they want, to invest in other things. But their family knows that that's what they're doing. And their family understands that when the day comes, we will get this much. Or they pay it back. There's also what they call premium financing, and premium funding, but that's for a different day. And I'm sure some of you have heard nightmare stories about that. And again, all because they were done incorrectly. You've heard nightmare stories about tax-free retirement. You've heard nightmares about infinite banking. You've heard nightmares about dividends, all because in 99% of the cases, they were done incorrectly. Paid up additions. Paid up additions are similar to dividends. And what that does is it increases the death benefit of your policy. Why do I want to do that? Because that allows you to increase the cash value, which you get the tax benefits of an increased cash value. So it allows you to build the value of the policy while staying within the IRS guidelines and fence posts. CVAT or GPT. CVAT means cash value accumulation test. That is an IRS guideline or guideline premium test. You're only allowed to put in so much premium for value of death benefit, or you're only allowed to accumulate so much cash value according to how much premium you're putting in. The IRS has rules, and 7702 was one of the IRS rules. There's several codes. And so you can use paid up additions to increase the cash value, and it helps you. That's the cash value accumulation and the guideline premium test, or why we use paid up additions to stay within those guidelines. All right, let's move on to, I think, the second to the last page. So life insurance can help get the gospel to the entire world. because it can help fund. Let's say I buy a $250,000 policy. And that policy now has grown several years, and I'm just throwing out numbers. These are just for illustration purposes only. Let's say that policy has grown to $50,000. And this group right here, that building behind them, there was a tornado or hurricane, and it tore off the roof. Over there, it probably wouldn't cost $50,000, but let's say I want to take out $50,000 to help with that building. I can send them that $50,000. I can take it out as a loan and give that to them. I didn't have to die to get that benefit. I'm helping the gospel to get out. I'm helping these people. And they're benefiting, and I will benefit as well. And I've been able to take care of my family. I didn't give away the whole policy, and if I want, I can pay that back at some point, but I don't have to. It'll come out of the death benefit. But in the meantime, another need comes up. My friend over in the Philippines, he gets from island to island on a little motor scooter, and his wife is on the back with him. And they got to go across these bridges. They're like rope bridges with wood planks. He rides his little motorbike across that bridge, and it broke down not too long ago. We can send him another motorbike and stuff like that, and he can get the gospel out. Or we can get a bike for his son, so his son can go out to different villages. I have a niece. She was in the Fiji Islands in Vanuatu, and she would have to climb up and down these mountains on foot in the jungle. And I'm very proud of her, by the way. But she translated the gospel, the book of John, for them. But she could have done that much faster if she'd had a motorcycle, a motorbike. That's what this is all about, is we want to find ways to help get the gospel to people that need it and people that want to hear. All right, last page. So I want to thank you for being here and taking the time to go through this with us. And hopefully this gives you some insight and options that you may have. And maybe a life insurance policy isn't the best for you. Maybe you have other ways or other things that you want to accomplish. But hopefully this at least gets you thinking that you want to help somehow in some way. So, all right, Daniel, I'll turn it back over to you and Michael.
All righty. Well, it's time to look for questions. We've got one here for you, Scott. It says, when you have a policy, is there a limit to how much of that value you can take out as a loan?
Yes, but it will change from year to year. And it depends on the carrier. It depends on the company. They will tell you how much you can take out. You cannot take out 100% because there has to be enough left in there for the administrative costs, and for it, to cover in case something happens to you. So there has to be enough in there to cover that cost. So if you had a $50,000 cash value, you could not take 50,000 out, probably 40,000 or something like that. It depends on the carrier. One thing I didn't mention is that there's a difference between what they call a mutual company and a stock company. If it says mutual, what that means is that you as a policy holder are part owner of the company. Whereas a stock company, you're just a policy holder. You don't have any ownership in the policy. And when you talk to people about infinite banking, they strongly urge you to use a mutual company, because then we get into the loans of either non-participating or participating. But that's a different webinar. Next month, we're going to have a wonderful time. We're going to talk about taxes. So everybody awesome. Get excited.
Well, it looks like that's it for the questions today. Is there anything else to close out before we end today?
I can't think of anything. Thank you for that
question. That was very enlightening as usual.
Well, good. And I just hope this all translates into getting more of the gospel out. So,
man,
All right. Do we need to hang around a little bit after to set up for next time, or do we want to set up a call later?
We'll probably do that later. All
Okay.
righty.
Thank
Well,
you.
Thanks everybody for joining, and we'll see you next month. Be on the lookout for email and social media posts for when we have that scheduled, and we'll see you all then. Thanks for joining. Have a great rest of your day.
All right. You too.
Um,
Thank you. Bye-bye.